So we've got the market down, our market up 18 points now. So there is a bit of a bounce which is seeping through as we speak. There is news at the bottom of the screen. This is Balrampur Chini shareholding. And remember, I mean, shareholding and changes in shareholding in the last quarter would be put up on the stock exchanges all through the course of this month. I mean, most of the month at least. Akash Bhanshali is upped his stake to 2.12% in Balrampur. From the earlier 1.97%. That is information at this point in time. Stock spiking up a little bit on that piece of information. Okay, so let's see if this turn that we're seeing lasts or not. Remember, we had Ashwini just a while back. He was saying, and I think at that point the market was at about 10,880 or so, that would be a good point to get in. And well, the markets seems to be listening. Let's see if this lasts. Gurmeet Chadda is co-founder and CEO at Complete Circle Consultants Private Limited. He's joining us right now to take some questions. So Gurmeet, you run a wealth management firm. You've got HNIs and family offices as clients. What's the mood like really at this point? Do people want to put more money in or stay away? What's it looking like? Just the feedback.
Yeah, so it's a bit of a neutral, it's been a tough 2018, and last year the best asset class was liquid, so it doesn't really reflect on, wealth managers like us. I think there is a bit of a, rejig happening in the portfolio. We are advising some fixed income weightage to go up, on a risk-adjusted basis. If you see, there is a real rates in India are about 4%. The OMOs have made the GSEC come down, but the corporate bond yields are still about 200 basis over the repo, which I think is a 2013 high. And, this OMO impact is quite understated in the market, So unlike a CRR, which only attacks the shorter end of the yield curve, the OMO has an impact across the yield curve, right? So if you have a 200 basis points gap between repo and if you are getting AAA bonds at 830 to 850, and with possibly some spread compression and change of stance, you could possibly look at a double-digit return in fixed income with very little incremental risk. So we are adding some weightage to fixed income. That doesn't mean we are bearish equity, but so we see some pockets of growth in equity as well. So we want to take advantage of the low-hanging fruit because I think the first half of this year would be more event-driven, with so much happening around. And the second half would be more macro and micro-driven. So that's what we are doing with clients.
With all this talk of what can be done in terms of a support package, etc., you don't think the fixed income market would react one way or the other, or you think?
So it would, but if you see there are OMOs, the recent one announced today for 10,000 crores, the government will buy back 80% of the bonds issued. So you are in a different zones where US is talking about $200 billion of tightening every 4 months. You are talking of, buying back 80% of the bonds. So I think it will be liquidity which will keep the yields in check. I agree with you. The fiscal maths looks a little bit of scary right now, and we'll see how things pan out. But for now, it looks so. If you are at the shorter end, then you're not really exposed to the. Because the corporate bonds haven't really rallied.
So you can, Gurmeet, play the entire fixed income space via the NBFCs as well as the banks from an equity standpoint. So what would your focus be, and what kind of position do you have towards banks plus NBFCs? So from an equity perspective, we are overweight corporate banks. I think our top order would be ICICI, then HDFC and Kotak. ICICI in particular, we believe that the asset de-risking is on. If you see, their loan book is now 5.5 lakh crores, which is 6% of the market share. The monetization of its life insurance and some of the insurance businesses, they've had the tier 1 capital capitalization improving to 15%. And we are seeing cost to income come down. Some write-backs could happen. They had a few, MTM lost last quarter because of treasury yields hardening. That could reverse. So you could possibly look at a very good number coming this quarter. And, at 1.7 book value, FY20, it's one of the cheapest private sector banks. So that's our top play. And some niche financials. We think that asset management and life insurance business looks very, very attractive.
Sorry, just to jump back to asset allocation, what kind of fixed income products do you recommend?
So twofold. One is your regular corporate bonds with a mod duration about 2.5 years. So if you do a AAA AA combination right now, and there are good AA ones available like a Shriram, Mahindra Finance, which are quality ones yielding 940, 950. You can make a yield of about 9%, which is the running yield. So a 9% running yield with possibly some compression could lead to a 1 or 2%. uptick there. So you could possibly look at 10-11% there on some of the debt mutual funds with 2-3 year mod duration. We're also looking at a lot of structured products, which are these Nifty linked debentures, in the market where you have an assured coupon linked to a certain Nifty condition. And that condition is typically so it's like if Nifty is positive, you get 9.5%. If Nifty is negative, you get 9.20. So just to ensure that the capital gain is about 10%, which is for listed debentures. So between structured products and short-term debt funds with accrual strategies where the fixed income is.
Coming back and jumping back to equities now, Gurmeet, tell us about a couple of more stock ideas that you're recommending to your clients, say within the mid-caps.
So one is a niche financial space we talked about. So our top pick is HDFC Life. If you see the VNB, which is value to new business premium, is the highest in the industry. That's 24%. Their ROEV, which is where the insurance are evaluated, is about 21-22% and consistently clocking that number. They have a huge bank assurance tie-up. Their dependency on HDFC Bank was 65% of the premiums. Today, it's only 50%. They have 25 banks where they have a bank assurance tie-up, about 70 NBFCs, so like 100 institutions where you have a bank assurance tie-up going. And some of it is being held by regulators. It's cutting down expenses, making it very, very difficult for people to sell more mutual funds. So you'll see an added shift of, distributors and banks go towards life insurance. And it's done very well, and even in the protection business, which is they have an 11% share in the APE, which is a high margin business. So that's one pick in financials.
What else? Anything else?
Yeah, so two more. So one is, as I think there are some themes which are secular and multi-year growth themes. One of them I like is the adhesives and the construction chemical space. So Pidilite is clearly a leader. I don't need to talk about adhesives and sealants, but look at the construction chemical space, where you talk about, floor hardening, you talk about decorative colors, you talk about waterproofing. This segment is growing almost 25-30%. And there is an increased brand awareness. This was a very commoditized space. And if you do dealer checks, you will see, they're running out of inventory in this space. So they have brands like Pidilite has Dr. Fix-It, they have Roff, so, and this business can significantly contribute to both the top line and the bottom line. If you see last quarter, they had a 2% improvement in margin, which was largely because of, and Pidilite has the pricing power. So if you have softer commodity prices, looking at the way global growth is, and you have the pricing power, and then there is a volume growth, I think it's a good combination to, look at this space.
Okay, all right, Gurmeet, we're going to wrap up the conversation on that note, but thanks very much for joining in and giving us your fundamental view and a couple of those stock picks as well. We'll take a break now, but up next, a conversation with the former member of the Planning Commission, Montek Singh Ahluwalia, on macros and economy coming up. Stay tuned.